to the Wall Street Geek, created 7 geeks ago, yet still aiming to help you become better informed about important money matters. But first, I've got a story for you. It's a story about a rope bridge and a really nervous guy. So one morning this guy was about to cross the rope bridge. It looked unstable, but no one fell off for 45 months, and he knew that, yet he was still nervous. So the next morning hit, and he was about to cross the bridge, and even though he slept on it overnight, he was still extremely nervous. As a result, as he crossed the bridge, it started to shake. So he's shaking, the bridge is shaking. Unfortunately, the bridge started to shake so much that he fell off into a deep ravine. Eventually, however, he met resistance in the form of a big leafy tree, which prevented his plummet to the bottom of the ravine. But the long and short of it is that his jitters caused this almost free fall, which leads us to today's topic. Today we're talking about market timing. One time around 2007, the Shanghai Composite fell more than 9% because investors in that market feared the government would crack down on speculation. Around that same time, investors in the U.S. reacted to a bigger than expected drop in new orders for U.S. durable goods. And at that very same time, investors realized that the last major pullback was almost 3 years prior, and analysts agree that there should be little pullbacks throughout the year. So bad news about global markets, ominous news about U.S. economic indicators, and expectations on technicals caused a perfect storm of jitters, which spurred additional drops in market prices because folks and high-frequency trading algorithms started selling. So in case I'm talking at 5,000 feet, let's level set everyone. So first, I'm sure you're aware of what an index is, but let's break it down anyway. If a country's economy is like your body, an index is like a thermometer. It's a measurement of the health of an economy. So for example, the Shanghai Composite Index is comprised of stocks that are representative of China's economy. And same with the Dow Index. It's composed of 30 stocks chosen by the editors of the Wall Street Journal because these stocks were determined to be leaders of the U.S. economy. But why did China's bad health affect the U.S.'s? Because we're all in a global economy, and the health of one economy in varying degrees affects the health of others. It's as if we're in a giant wading pool, and things have been so mild and flat lately that a wading pool is what it actually feels like. So if we're all in the same wading pool and some dude cannonballs, then everyone in the pool will be affected to some extent. So indices and other health measurement tools like economic indicators, and if you don't know what those are, please view my last video about economic indicators. All of these things are good economic health thermometers that are reflective of the internal well-being of an economy. Second, speculation. What is it? As I said earlier, not too long ago, the Chinese government wanted to crack down on speculators in their market. Speculation is buying and selling without the intent of holding on to an investment for the long term. When there's buying and selling, it causes fluctuation in price and volume, and that makes other investors or trading algorithms feel that there's interest in an investment, but the interest is actually artificial. There was a great 60 Minutes episode recently about speculation in the form of high-frequency trading algorithms, where the fundamentals of the stock, in other words, whether or not the stock is a quality investment, the fundamentals weren't taken into account, just patterns and technicals like price patterns or volume patterns and volume changes. High-frequency trading algorithms can buy and sell thousands of times in 1 second, maybe a penny profit each time. But multiply a penny profit times thousands of trades each day, and that's a nice chunk of change. But it's also perhaps an artificial run-up or a manipulated dip, and that's not investing in the Warren Buffett sense of the word. Now, what's a pullback? It's another way of saying oftentimes a needed decline, kind of like right-sizing, which is a word that makes me cringe. But what happens? So say that you have an eBay store that sells Rolling Stones memorabilia specifically to people in Dubai. And say that one day you wake up and find out this big Stones concert in Dubai didn't sell out. Well, you want to make sure that your memorabilia continues to sell even though the interest may be lower in that market. So you offer a lower price on those fake Mick Jagger lips in hopes that you can continue to sell well in Dubai. Throughout the day, if you're not attracting buyers still, you'll pull back the price even more and lower it until the value hunters come along and buy that memorabilia at a bargain and provide price support, but at a lower level than before. Now, Rolling Stones memorabilia are value investments to certain people, so even though those people bought the plastic lips at a bargain, the memorabilia will eventually go back up in price. So during a pullback, you can buy a good quality investment for a lower price than normal. And because it's a quality company, that price will eventually go back up. It's like a sales at Saks Fifth Avenue. That's the way I see it. So what's the big picture? We learned about pullbacks, market indices, and economic indicators, speculation, and why the market may have a day after day of positive or negative returns due to the reaction of investors to economic health measurements. The next time jitters cause a pullback, don't jump off that bridge. Value hunt and enrich your portfolio. And we'll talk more about how to do that in another video, so please come back. But until then, I'm the Wall Street Geek, hoping that you live long and profit. Thanks for watching. Bye.